In October 2023 paper unit 2. So in the first part we had solved, okay, we are preparing the statement of financial position for Matara Clothing. We had calculated the total assets of equities and the liabilities section. So for the equity section, let's see that first one is the share capital, okay, that is ordinary shares, okay, ordinary share premium, okay. Then you have the revaluation reserves, okay, because the properties, okay, these two things were revalued, so you are going to create a revaluation reserve properties. And then you have the general reserves, then foreign exchange reserve, then you have the foreign exchange reserve, foreign exchange reserves, okay, and then you have to include the retained earnings, which is also a part of non-current assets, okay, at 2 million, okay, and there has been no changes to this, so I'm going to include 2 million, okay, 2 million. Then share capital premium mentioned here anywhere, so you are going to just include it, okay, 200,000. And then for the revaluation reserve, okay, for the revaluation reserve, it was calculated in the previous year, okay, revaluation of the factory 42,500, and then the revaluation was around up by 219,000. So these two together, okay, you have to add and get the revaluation amount. So 219,000, okay, plus 219,000 plus 42500, 261,500. That's the revaluation reserve. Then you have the general reserves. General reserves, it is around 40,000. So general reserve is at 40,000. And then you have the foreign exchange reserve, okay, the foreign exchange reserve is at 30,000. Foreign exchange reserves is at 30,000. Then you have the retained earnings, okay, retained earnings, you have to do adjustments. Retained earnings, before any adjustment you will take first, okay, that is 255,650, okay, it is 255,650. And then you will add the profit, because the profit for the year was at 298,000 before the adjustments below, so you will add the profit also. Then you will have to, okay, you will have to subtract all the depreciation amounts or the and dividend, okay. The depreciation we had calculated for the motor vehicles and plant and equipment, so those depreciation amounts we have to remove it. So the depreciation amount for the motor vehicle was 16,000 and depreciation for the plant and equipment was around 7,200, okay. Motor vehicle depreciation, and then you will have to subtract motor vehicle depreciation, plant and equipment depreciation, this you will have to subtract, and any dividends paid, okay, the final dividends paid also you will subtract. Now let's write the value. Add the profit minus motor vehicle depreciation. Motor vehicle depreciation was around, okay, the motor vehicle depreciation was around 16,000. And then 7,200 was the plant and equipment depreciation, because it had to be depreciated every year. So 7,200 minus the final dividend 1,000. This also you will subtract from the retained earnings to 50,6,450. So the retained earnings after the adjustment is going to be 506,450. Equity section, so this value is going to be equal to 303 7950 3037950. Okay, now let's calculate the total non-current liabilities. So the first one is going to be equal to the debenture, that 9% debenture in 2027. Okay, that's going to be the first non-current liability. And then you have taxation. Okay, the taxation, it includes current liability and non-current liability. So the taxation is going to be equal to, that also comes under the, some of them are due this as a current liability. And then damages payable. Okay, this possible damages. Okay, these are the non-current liabilities. Okay, this is not coming under the current liability, because he says that the case is not taking up till 2025. Okay, so that's why it is becoming a non-current liability. Otherwise it would come under the current liability. Okay, just because they have mentioned the statement, no adjustment, so you are going to write just like that. And then you have taxation, so that is equal to 252,000 minus 67,000. Okay, so now we can add up. So this value is going to be equal to, liabilities are going to be equal to draft, then you have the bank loan, then you have the trade payables and other payables, then you have the other payables, trade payables, other payables, and then you have the debenture interest. So you have the debenture interest, bank loan interest, and then you have the dividend payable. We can see it is at 27,800. Okay, so there has been no changes to this bank overdraft. Loan is 50,000. Bank loan is 50,000 and bank loan interest is 12,750. Now let's then you have the trade payables, which is at 110,000. And then you have the other payables, which is at 3,500. Now the debenture interest, okay, is given here. So, and it is equal to 36,000. And then bank loan interest is 12,750, and dividends payable we had already calculated 0.012 times 2 million, so that is equal to 24,000 is the dividends payable. Now current tax payable, okay, current tax payable, tax due is at 67,000. Three 331,050, okay. So that is the current liabilities, okay, current liabilities. So we can see that now let's add up the total of these three, okay, the total of these three, equity and the total of non-current liabilities and the total of current liabilities. So that is going to be equal to 4454,000. So now we can see that the total assets is balanced against the total equities and liabilities, okay.